our take on the economic outlook for the country. So I will quickly go straight to the presentation. I'll be sharing my slide. As you know, we'll share these slides subsequent after the presentations. So I guess you can see. Okay, I need to go to the. So, like I said, it's good. We're going to be reviewing the performance of the economy in the past second quarter, and which also implies the full first half of the year. And then we'll also be hazarding a guess on what the future looks like in the coming months, or the current quarter of the third quarter of this year. So normally we will start by what we call a top-bottom approach. We start from the global economic environment, and then we drill down to the Nigerian economic environment. Then, of course, we know the economy cannot operate without the politics. So we will make a little foray into the political environment. So this executive summary, this is basically what some of the things we'll be highlighting. Of course, we know the main factor that defined the global economy in 2022 was the war in Ukraine. We've seen that war has not fully abated, but in the current year, we've seen the impact of that war continue to impact on global economy, added to the high inflation rate, increased national debt, particularly among poor countries, including African countries. Of course, we know Ghana has reported in payment of its national debt. Concerns about the health of the global economy has continued to persist as a result of expectations or projections that the US economy would go into a recession in the second half of the year. This year, we know that the German economy went into a recession in the first quarter of this year. So there are concerns, including comments by Federal Reserve Bank staff who are also forecasting that the US economy will go into what they call a mild recession. This we are driven by three major factors. One is increased interest rates, which has negatively affected some banks in the US, particularly regional banks. We've seen bank failures in the US in the past 6 months, and then the persistent inflation pressures. Then, notwithstanding this, the benefit of decrease in food prices and energy costs and enhanced supply chain efficiency has kind of lowered the risk in some, particularly the financial sector. Commodity prices spiked after Russia invaded Ukraine, but had leveled off. Of course, we know the geopolitical tension is still there. Recently, I think this week, Russia said there's no justification, there's no basis for it to extend the agreement to allow for continuous shipment of wheat from Ukraine to the Black Sea. Of course, we know Russia currently controls the Black Sea. But on the positive, we've seen China rebound as a result of fully lifting the restrictions they had imposed on COVID as a result of COVID-19. The US Federal Reserve Bank, conscious of the fact that the US economy could go into a recession, left interest rates unchanged at its last meeting in June. And that was, like I said earlier, there are also speculation, including economics within the Federal Reserve Bank, that the US could go into a recession. So they wouldn't want a hard landing. So they had to keep interest rates at current levels. Then we are aware of the Wagner military mutiny in Russia, which has put some kind of exposed the crack in the Russian president's control of the political apparatus in the old Soviet Union. Of course, we know the implication of that Russia is waging a war against Ukraine, which is in effect indirectly waging a war against the Western countries. And should anything happen to the hold on power, that could change the equation on that war. President Bola Tinubu's administration has made some fundamental economic changes. We know that Asiwaju Bola Ahmed Tinubu was sworn in as the 16th president of the country on May 29, 2023, and has actually within that time made some what we call fundamental economic policy pronouncements that can alter the Nigeria's economic trajectory if the social impact on the most vulnerable is well managed. The government has also clearly made it clear that it does not have the resources to continue with unproductive subsidies. Subsidies on PMS, premium motor spirit, subsidies on FX, subsidies on education, as well as subsidy on other aspects. I understand the slide is now moving. Okay, let me see. I'll stop sharing and share it again. Okay, I guess can anybody confirm the slides are moving now? Anybody
Yes.
can?
Yes,
Okay.
the slides are moving now, sir.
Okay. So as I was saying, the current president under Asiwaju Bola Ahmed Tinubu has made it clear that they have no skin, or they're not willing to continue with unproductive subsidies on PMS, subsidies on FX, electricity subsidy, and education subsidy, some of which have been impediments to the country's economic growth. The policy pronouncements on fuel subsidy removal and elimination of multiple foreign exchange rates that the new government government has implemented seem to resonate positively with investors, as the Nigerian stock exchange or Nigerian exchange all share index gained 18.96% in the first half of this year, driven largely by gains of 6.42% in May and 9.32% in June. So let's go to a review of the global economy. The IMF forecasts that the world economic outlook in April projected a growth of that the growth will fall to 2.8% and 3% in 2023 and 2024 respectively. These are indications that the recession, the projected recession we've seen, we are talking of in US, and the existing recession we have in Germany are likely going to affect global economic performance in 2023 and 2024. Of course, UK is also being speculated to possibly go into recession in 2024. So that can explain why the IMF is projecting that the global economy will slow down further in the current year and the coming year. As I said, the gloomy outlook reflects the concerns on the health of the major economies, including the US, Germany, which entered into recession at the end of Q1 2023, driven largely by the Russian-Ukraine war, high inflation rate, rising energy prices, and supply bottlenecks. Of course, we know Germany is one of the European countries that suffered most from the rising energy, from the global crisis occasioned by that war, because German power supply was largely coming from Russia. It's expected it's expected that Germany will suffer the most from that, and that's why the German economy, as you also may know, German economy is the strongest economy in Europe. German economy is actually the propeller for European economic performance. On the positive side, 23 banks were subjected to Federal Reserve stress test this year, and the 23 largest banks in the US all came out clean, which means that the crisis we've seen in the financial system in the US may not have become contagious. The concerns that the US will go into recession were that we saw an inflation rate of 9% in the US. We've seen a banking crisis, and those are what they have been gas in the US for an economic recession. Growth has picked up in China, expanded from a 2.9% Q4 2022 to 4.5% Q1 2023, with a full reopening of the global economy. of the Chinese economy after the lockdown. In the commodities market, crude oil prices are projected to fall by about 24% and 5% in 2023 and 2024, respectively, while non-fuel commodity prices are expected to remain broadly unchanged. This according to a report by the IMF. Crude prices expected to fall this year is actually driven by the fact that the US economy is slowing down, German economy has gone into recession, the British economy grew by just about 1%, and so the propellers of global economic growth will likely be basically China and India. And we know that both countries are getting their crude supply, both countries are circumventing the price limits placed on Russian crude, and they are getting their crude supply at significantly lower prices from Russia. So what that means is that the other countries that are not in that category the demand for crude will drop because US still remains the largest consumer of petroleum products in the world. So if the US is slowing down and Germany has gone into recession, so you can actually understand why it's expected that crude prices could drop as low as 24%. We know that crude price had dropped last year, March, got to as high as $130 per barrel. But today we're dealing with about $75, $76 per barrel. There were concerns a couple of weeks ago that the US Parliament will not be able to, refuse to pass a higher ceiling for the US debt. And that would have led to a default by the US government. Had that default happened, the world economy would have gone into crisis because virtually most countries are holding US treasury instruments. China, India, and a lot of countries are holding their reserve in US currency. So, but that was luckily or fortunately resolved, and the US Parliament approved an increase in the debt ceiling. The outlook for growth is still highly susceptible to downside risk. The short and medium-term picture of is largely clouded by uncertainty as the world economy responds to shocks of the 2022 and the recent volatility in the foreign exchange market, the financial market. On the upside, the global economy can turn out to be stronger than anticipated, just like it happened in 2022, when there were projections that the global economy will decline. Household consumption may surpass expectations once more due to a stock of surplus savings from the pandemic years and tight labor market in a number of economies, which had made it difficult for companies to retrench. But on the downside risk, global outlook could see global central bank could see persistent tightening of global financial conditions as a result of systemic sovereign debt distress. I've mentioned earlier that countries like China, Ghana had defaulted on their sovereign debt. So if you look at the bar chart on your right, you will see Q1 GDP growth rates. US grew by 1.1%. UK grew by only 0.2%. That's a marginal growth. Europe grew by 1.3%. China 4.5%. Russia was in decline at 1.9%. In terms of interest rates, you can see the US interest rate remained unchanged at 5.25%. Britain increased rate from 4.5% to 5%, and Canada increased it from 4.5% to 4.75%. The Eurozone increased from 3.75% to 4%, and Nigeria increased from 18% to 18.5%. We can see global inflation, which averaged about 7%, 7.5%, when you put everything in a box. We've seen, but we expect that, excuse me, we expect inflation rate to moderate. We've seen a moderation in the US. We've seen moderation in other countries like China, Russia, and so in the second half of this year, we expect inflation rates to moderate further across the most mature economies. But the emerging economies will be the problem. We expect this inflation rate to remain obstinate in emerging economies. Of course, we know Nigeria is actually projected to even increase beyond the 22.41% we had in the month of May to about 30% by the end of this year. Now, let's go to the local economy. Like I said earlier, Asiwaju Bola Ahmed Tinubu was sworn in. Please pardon the, I need to correct this. This is the president name. Like I said earlier, Alhaji Asiwaju Ahmed Bola Tinubu was sworn in as the sitting president of the Federal Republic of Nigeria on May 29, 2023. The highlight of the president's speech, the inaugural speech, which has resonated with the private sector investors, are what we are presented here. The president said the GDP is expected to grow at an average of 6% in the first 4 months of in the next 4 years due to targeted reforms are stimulating the sector of the economy. So the sectors that we focused on are on power sector, where they said they will encourage power generation, transmission, and distribution across states from local sources and ensure its accessibility and affordability. Budgetary reforms to stimulate growth without engendering inflation, promote domestic manufacturing, and lessen Nigeria's import dependence through full-range fiscal measures. On the monetary policy, the government said the monetary policy will be reviewed to support this sector economic growth. The central bank was expected to unify the exchange rate, which has been done, which has happened, as well as that they were expected to eliminate arbitrage. So on fuel subsidy, the government said they had eliminated fuel subsidy. There was no fuel subsidy, no longer fuel subsidy. And we expect this to have direct impact on public infrastructure investment, education, healthcare, and job creation, as monies being spent on fuel subsidy are going to should be related to critical sectors of the economy. We'll speak a lot more about that as we progress in this presentation. One of the heavy lifting, which we have advocated repeatedly as a different fora, is that of removal of fuel subsidy. Like we said, that the president announced in his inaugural speech that there is no longer subsidy on petroleum products. Subsidy on petroleum products was gone. The payment of subsidy had actually become unsustainable in fiscal terms, as government total revenue was barely able to cover the subsidy payment at about 5 trillion naira per annum. Recall that the GMD of NNPC and the former Minister of Finance had said that Nigeria's daily subsidy on petrol was about 18 billion naira. If you multiply 18 billion naira by 365 days, you're going to get something like 6.54 trillion naira, which is about the amount we are spending on subsidy. And if you recall that last year, the federal government budget, total revenue as of November last year was only 6.5 trillion naira. So in effect, subsidy payment alone was enough to erode federal government's total revenue, which made it, like I said, unsustainable for government to have continued that. The World Bank is predicting that the remaining part of this year, starting from the month of July or June, when the subsidy was removed, the government will save about 3.9 trillion naira by December. And that this could be channeled to infrastructure, education, healthcare, and other important sectors. Of course, we know that consumption of fuel would ordinarily come down with removal of subsidy with higher price of fuel. So we've seen an estimate of about 26 million liters drop per day in terms of consumption. We also expect that federation allocation will increase. These are the possible impacts of the fuel subsidy removal. Our projection, this is carry projection, is that the federation allocation will increase by between 400 billion and 550 billion per month. This will lead to an increase of monthly distributed FAC by about 50% from an average of 815 billion that it was in the past 1 year. average monthly distribution of 815 billion that was recorded in the past 1 year. And how did we arrive at this? Like we said, if you take a subsidy payment of 18 billion and you multiply that by 30 or 31 days, you're going to have something like 550 billion per month. And that is the amount we should save by not removing subsidy, granted the fact that even consumption has declined. But on the converse, we expect that citizens will face higher transport costs, reduced disposable income, significant adjustment in household expenditure. This, for me, or for us, is an area that the government must take seriously. When we, at the beginning of this presentation, we did say that if the social impact of the subsidy is well managed, it will be a positive on the economy. But the social impact as such that could actually, if not well managed, could actually spell disaster. So we think government has to respond timeously to dealing with the social impact of the subsidy removal. We know we've heard the government is working on some palliatives. We should expect an uptick in inflation rate. We had mentioned this earlier, that economists is predicting that Nigeria's inflation will end at about 30% at the end of this year as a result of subsidy removal and harmonization of exchange rate. In a second of its kind, the newly inaugurated president of Nigeria, Asiwaju Bola Ahmed Tinubu, suspended the central bank governor. Why we said in the second of its kind, remember that then former President Goodluck Jonathan had also suspended the former CBN governor, Sanusi Lamido. And Emefiele's suspension was most expected after strong criticism from Tinubu's camp before the February presidential election, including allegation that the CBN governor was trying to sabotage Mr. Tinubu's campaign with the Naira redesign and cash withdrawal limits. Of course, we are all familiar with this allegation, this fact that the late allegation that the CBN governor was trying to sabotage. I think it was even repeated 2 days ago while he was in Abeokuta, that the policies of the central bank were meant to frustrate the election result. Again, interestingly, the Business Day newspaper did carry out a survey of the performance of Nigeria's local currency in the past, in the regimes of the past CBN governors. And he came up with the conclusion that the Naira depreciated most under Mr. Godwin Emefiele, where the Naira started at 183 Naira to $1 when he became the CBN governor and ended at about 758 Naira to $1 at the parallel market. Floating the exchange rate under of required heavy lifting that has happened. Nigeria officially floated its currency after years of sticking with a hard peg that spoke to investors and drained dollar from the economy, signaling an end to multiple exchanges. The existing market segment collapsed into the investor and exporters window, where you have a willing buyer, willing seller model with a bid asking rate of 1 Naira spread, another book for transparency and seamless trade execution. Well, the managed flow that was introduced in 2016 has not really helped matters. Like we said, we've seen a decline in exchange rate from about 183 Naira, 186 Naira to about 758 Naira during the, I think 8 years or thereabout of Mr. Godwin Emefiele's reign as the CBN governor. Now let's look at the impact or the expected implications of floating the exchange rates. Well, one of the things we should expect from this is that we should expect improvement in capital importation, foreign capital investment. We've actually seen some improvement. We saw the Naira vote on the exchange increased. Foreign portfolio investors Naira vote increased from 4% to about 11%. In the month of June. Of course, that is still paltry, given what used to happen in the market and given the size of the Nigerian market. But ordinarily, we expect that the floating of the naira should attract foreign investors by providing with more transparency and market-driven exchange rate mechanism. The concerns will be that the rate of volatility, which we currently see experiencing, will keep away investors. And we need to achieve two things: market liquidity and stability in the exchange rate. It doesn't matter where it stabilizes. What matters, it does stabilize. Investors will not be comfortable if you don't have foreign exchange liquidity, and also if you do not have stability in the exchange rate, because clearly they want to come to the market and they want to bring in their funds into the market and exit at a defined range. If you've seen so much of volatility, nobody wants to come into that market, because that volatility could mean that when you are exiting the market or when you've sold the instrument you invested in, you make an exchange rate loss. So those two factors are simply none for foreign portfolio investors to aggressively come into the market. We expect that the harmonization of exchange rate at a higher level will lead to inflation. Of course, that is no brainer. There are some products that used to be imported at official rates, including fuel, which is now going to be imported at a parallel market rate, or not really parallel market, at IE window rate. Of course, one of the things we also recognize that the Nigerian economy has now been more closely linked to global economy. So whatever happens in the global economy will translate directly into the local economy. So some of the shock absorbers and circuit breakers we had in the economy have now been taken up by eliminating the exchange rate, multiple exchange rate, as well as removing the subsidy on petroleum products. So in effect, is if crude prices go up, then refined petroleum product will go up, and imported product will go up in the country, because we're using a parallel, an IE window rate. So that will have a direct transmission of the price of pump price of fuel. So these are some of the things we should expect as a result of this. Export competitiveness, of course, we know that when you see the kind of devaluation we've seen from about 430 naira to $1 to about 750, 760 naira to $1 we are trading at today, it should also ordinarily incentivize export. But unfortunately for us, we do not have a lot of value addition in our export commodity market. Our export still remain largely export of petroleum products, crude and crude-related product, and gas. So, but in any case, in the medium term, we should expect that a higher exchange rate will incentivize even people to set up manufacturing activities in the country that will export some level of value-added materials from the country. On the fiscal side, we expect that the floating of the exchange rate will lead to higher FAC allocations and higher revenue for the 3 tiers of government. I had really talked about the impact of removal of subsidy on the federation allocations. The second positive impact will come from what the harmonization exchange did. Previously, dollar was being converted to at the official rate of maybe 430, 460 to $1. Today, going henceforth, all foreign exchange earnings that come into federation accounts will be converted at the previous day's closing exchange rate, which means if you are going to be converted at current 750 or 760, you're going to see the impact alone leading to a significant increase in FAC allocation. So you're going to see a FAC allocation that could possibly touch in the region of 1.3, 1.4 trillion naira per month in subsequent years, in subsequent months, not years, before the end of this year. The impact of improvement in export competitiveness will be an improvement in your balance of payment. Remember that petroleum products importation accounts for more than 25% of our foreign exchange, our imports. So we are seeing a moderation in consumption. The impact of that, the demand for forex, for importation of petroleum products will decline, which will give a salutary effect on your balance of payment. But dwelling further on government revenue and fiscal policy, it's also necessary to mention that citizens should show more interest in how governance takes place. We should see more of citizen activity, because the government revenue will increase significantly. And if it is properly deployed, we should see investment in critical infrastructure, which will create jobs for people who are currently not employed, including blue-collar jobs. And those people who are earning income from being employed in contracts execution will consume, and that will lead to some level of recovery, economic recovery, if the savings are properly deployed. This is how the economy performed in the first quarter of this year. Of course, we don't have the GDP figures for the second quarter of this year, but you can see the major sector that grew, the sector contributions in agriculture. Agriculture still accounts for the highest, contributes the highest in the economy. Today, at agriculture, they did 1.6% contribution. Today, ICT, that used to be an inconsequential sector in the economy, is now the second largest contributor to the economy. What does this speak about or tell us? It simply means with the right policies, we can stimulate some of the sectors that are very weak today to become major contributors to the economy. If, as a result of the reforms that was engendered or implemented by the passenger government in the early 2000s, where lines were issued to GSM operators, we're now dealing with a sector that has grown from less than 1%, less than 2.5% to 17.47%. That will show you the opportunity with other sectors also put. I always say that there's no sector in the economy that has fully matured. All the sectors both significant growth opportunities. Trade sector has been pushed to the third position at 15.97%. The manufacturing sector comes fourth, mining and quarry, where you have the oil and gas sector comes fifth, real estate sixth, and financial services seventh. Construction at eighth position, and down there you can see how the economy has remained over that time. Inflation has remained sticky. We've seen a number of contractionary policies of the government or the monetary authorities that have not been anywhere have positively succeeded in fighting inflation. So inflation in May was 22.41%. That mentioned that their projection that the inflation could get as high as 30% by December this year. A friend of mine came here yesterday and asked me, what does it mean that he had heard about this inflation getting to 30%? And what does it mean? And I told him that basically that if inflation becomes 30% in December this year, then means that price of goods and services that we are sold for 100 naira, any product was sold for 100 naira on average, December last year will be sold for 130 naira by December this year. The greatest challenge we have with inflation is actually coming from food inflation. Food inflation came at a rate of 24.82%. This is the highest in more than since 2005. So, so that's almost 18 years that we've seen this kind of increase in inflation rate, food inflation. What does this tell us? The greatest challenge we have as a country in terms of managing inflation in the country is food inflation, because food accounts for the highest share of consumer consumption in the country. And what that means that if we are able as a country to address the food inflation issue, which is what Western countries they have been able to do. If you go to US, one of the cheapest commodities you can actually consume is food. That applies to a lot of the Western economies. So if we're able to achieve that, we'll observe that inflation ordinarily will moderate. We actually saw a moderation in core inflation from 20.14% to 20.06% between April and May this year. On the positive, Nigerian production moved from 999,000 barrels a day to about 1.184 million barrels a day in May. That could be partly attributed to the engagement of non-state actors in managing the pipelines. And so Nigeria has assumed this position as the leading oil producer in the country. Of course, we know that OPEC Plus had a meeting last month and decided to cut production by about 1.6 million barrels a day, but that did not affect countries like Nigeria, Congo, and Angola. I think one of the, I think either Iraq or Iran, I think Iran, because they were not able to meet their OPEC quota. So we were asked to maximally produce at the level that we produced last. I think the highest we did was about 1.38 in the past 6 months, was about 1.38 million barrels. So that's in effect our cap currently. Of course, I said earlier that we just produced about 1.18 million barrels in the month of May. Despite this tightening in production, we only saw the market rally briefly, but after that, it couldn't sustain the rally. And we've seen Bonny Light currently trading at about $76.2 per barrel in June, down from about $80 per barrel it closed in the first quarter. But remember that government budget, the current budget that we are still implementing, of course, the new government has not come up with a supplementary budget. It was based on the $75 per barrel of crude price and the 1.8 million barrels daily crude production. Some of us had actually said at that time that this budgeted crude volume was not realistic. So clearly, the government is witnessing a negative volume variance, which is leading to further increase in this deficit that the government had budgeted. Remember, the government had projected a deficit of 12.1 million barrels, 12.1 trillion naira. So with the negative crude variance, we should expect that that budget deficit will increase beyond that in the current year. Our reserve has seen a decline, consistent declines in January from about 37 million. Sorry, this is 37 billion. So we've seen a consistent decline in reserve from about 37 billion to about 34 billion. Interestingly, we saw the last report we saw was a positive balance of trade for the first quarter of this year. But interestingly, apart from the balance of trade, the invisible side, obligations of the federal government, obligation areas of unmet foreign currency remittances from dividend payments and capital repatriation, payment for matured letters of credit have all continued to erode the federal government's, the central bank reserve. Of course, we know capital importation has remained very weak. I think about 5.8 billion dollars for what we got last entire of last year, which is actually embarrassingly small. So we've not seen any sharp increase in that, and that's why we're seeing an erosion in foreign reserve. But good thing is that sorry, there was a network breach, like they say, or technical glitch. There was a technical glitch coming from the network. Apologies for that. So we continue from where we stopped. So as I was saying, the national debt has continued to balloon. At the end of March, the DMO said that national debt was about 49.85 trillion naira, about 108 billion dollars. That was excluding the 22.7 trillion naira ways and means that has been approved by the National Assembly to be securitized. So if you throw that in, you are talking of the region of 73 trillion naira. But even if you take the 49.85 trillion naira, this was an increase of about 7.8% from the figure recorded as of December last year. The external debt increased by about 5.5% since the end of December to reach about 19.64 trillion naira, or $42.67 billion dollars as at March. The federal government debt, particularly the dollar-denominated portion, will have to increase as a result of adjustment of the exchange rate. The exchange rate they are used to, that was used to convert it to naira. So that's the impact of that is likely going to be an 12 trillion naira increase in the national debt, which could spike the national debt about 90 trillion naira when you add the ways and means funding that has now been collateralized. Of course, the impact of this is that we're going to have a debt to GDP about 37%, which is close to the government's so-called ceiling of 40%. Debt service to GDP will also increase in naira time, but with what I had mentioned earlier, that the government revenue will increase by between 400 and 550 billion on a monthly basis, about 6.5 trillion naira in a year. That is federally collected revenue. And then we should also expect an increase as a result of the exchange rate adjustment. So in terms of impact on debt service to revenue, I think that would be quite moderate. On the equities market, we've seen the market on a steroid. We saw the market gain about 18.96% in the first half of this year, with the market capitalization increasing by 17.25%. Most of the increase were as a result of what happened in the month of May and the month of June. If you look at the slide, the bar chart before you, you will observe that the market is a barometer for the level of optimism or pessimism that an economy has. In the month of January and February, we saw the market gain 3.1% and 4.3%. That was when all indications were that we had three frontrunners who are all market-oriented economy, and that the election was going to be free and fair and will reflect the wishes of the citizens. So when the election was held in February, on February 25th, and the process of the election, the entire electoral process fell short of the expectation of citizens. Investors became kind of discouraged or became pessimistic, and we saw the equity market decline by about 2.3% in March, and again 3.37% in April. But when the government was inaugurated in May, then the pronouncements were made, and the market gained just a single day after the inauguration. The inauguration was on Monday, the 28th. Then on 29th and 30th, was on 29th, the 30th and 31st were both market days, and the market ratcheted up almost 6% from those 2 days. So, and then in the month of June, the market upped its ante by gaining about 9.3%. So as we speak now, the market has gained about 18.96% by the end of June. These are to show you the sectors that had driven the market gain performance. We've seen the year-to-date for the oil and gas sector. Oil and gas sector has remained the leader in terms of market performance. We've seen a year-to-date gain of about 67.76%. Of course, this is not far-fetched from the fact that subsidy had been removed, and downstream operators can now effectively deploy the economic resources to optimize and maximize earnings. So we saw that sector gain about 7.76%. We've seen we saw the insurance sector. Interestingly, I will say surprising, insurance sector is the second best performing sector in the first half of this year at about 59%. Of course, the insurance sector is one sector which expect the government to implement some reforms in terms of capitalization. It seems to be the only sector of the Nigerian financial service sector that has not witnessed the major reforms that other sectors have witnessed, like the banking industry, the pension fund industry. Then followed by the consumer goods sector at about 51.93%. And then you had the banking sector at about 54.59%. What this means is that if you had taken a basket of any of the stocks in any of these sectors, you would have achieved about 67% if you had invested in the entire basket of the oil and gas sector. Then, like I mentioned earlier, we are beginning to see in the month of May, foreign investors' participation in the market increased to 11.5% from a low of 4.4% recorded in April. We need to check the figures by the time they publish the figures for June. Evidently, the unification of the exchange rate resonated positively on both foreign and local investors. So we also saw a significant increase in total transactions value and total transactions volume in the period under review. So the bar chart by your right captures those changes in volume and value. So if you look at let's look at the sectoral analysis of the market. If you look at the banking sector, which I said year-to-date performance of 54.59%, you see the factor, those that drove that sector. We saw Sterling Bank gain about 140%. Wow. Access Bank 88%, Stanbic IBT 61%, Fidelity Bank 60%, GTCO 50%, UBA 47%. These are the leaders in that sector. This was despite the fact that some of the banks had actually booked huge loan write-off as a result of their exposure to Ghanaian bond. I had mentioned repeatedly that Ghana defaulted on payment of a sovereign bond and is currently engaged in kind of restructuring with creditors. Of course, interestingly, the banking sector is benefiting from the high interest rate environment, which had led them to increase their lending rates without necessarily increasing their deposit rates. So that has led to an expansion in banking sector net interest margin, which is flushing positively into their into their bottom line, which is what we have captured over. So, and then interestingly, the banks that hold huge positions in foreign currency, that have positive foreign currency positions, will actually see a further boost in their earnings as they recognize exchange rate gains. And we know that the central bank does not allow Nigerian banks to hold so much of negative open position on foreign currencies. So many of them actually hold positive open position in foreign currencies instead of negative open position in local currencies. The only challenge we have is that if they funded any of their for those that have offshore lending accommodation from foreign banks, and those were lent in local currencies, then that would create problems for those those banks. But we don't think we so much see have, because a number of them had actually, foreign lenders had actually recalled their on lending facilities in Nigerian banks. We expect, like I said earlier, an increase in FAC allocation. This will flush into higher liquidity in the banking system, which will further depress interest rates, particularly deposit rates in the banking system. The industrial goods sector. Of course, we know some of the things that played out in the industrial goods sector with Transcorp, where Mr. Femi Tedela and Tony Limeli struggled to outbid themselves, so they bidded up the price of Transcorp. So we've seen Transcorp record a 152% increase between quarter on quarter. And then if you look at those gainers, the major, the Transcorp gained 152% just in the second quarter. But if you look at those that gained overall in the first half of the year, you see the Transcorp at 251%, which means price had gained 251%, Gilebeja at 26%, Lafarge 22%, and Dangote Cement at 9%. So in effect, what you saw in the industrial goods sector, where the sector only grew by 3.6%, or year-to-date was only 3.6%, was largely as a result of the propelling effect of Transcorp. We expect this sector to continue to benefit from the policy of the government, lower interest rates. The government said they are going to focus less on inflation fighting and focus more on creating an environment that will stimulate local productive activities. The oil and gas sector, this sector I had mentioned earlier was the biggest gainer year to date of all the sectors in the exchange, driven largely by MRS. Wow, gain of 464%, Etana PLC 215%, Connoy 213%, and Total at 81.35%. I had emphasized why we are seeing this kind of gains in the downstream oil and gas sector, because the expectation is that with the subsidy removal, they will be unshackled to deploy their network of retail outlets instead of depending on the NNPC to import refined petroleum products. So among the things we should expect is that in this sector, of course, we know only Seplat is the quoted upstream operator. We should expect that the reforms that the government had initiated in terms of passing the Petroleum Industry Act will now be fully deployed. We know part of that was suspended. That portion that was suspended was the issue of having a market reflective pricing for different petroleum products. We hope that the government will engage non-state actors, or engage not necessarily non-state actors, engage inhabitants of Niger Delta to curtail and let them have a share in the value being created by products mined from their localities, and as well as strengthen law enforcement so as to improve on crude production in the country. We expect Dangote to come on stream. Dangote refinery has been commissioned. Whether it can come on stream earlier than many had expected is yet to be seen. I think they have said they will come on stream before the end of this year. We expect that if they do achieve that, we should see a positive impact on the Nigerian oil and gas sector. The telcos, these ones have become, like I said, they have become the second largest contributor to the GDP. They have completely trumped over trade sector, trumped over manufacturing sector, trumped over oil and gas sector. And that sector, this sector continues to grow. With MTN having rolled out its 5G, and Airtel has also rolled out its 5G, data service have been the factor driving the telecommunication sector. We expect this to continue in the coming months, despite the fact that we should expect, I had mentioned earlier that the consumption pattern will change. Households will have to adjust their consumptions to reflect more of critical commodities or critical products. But we expect that the telco companies will, particularly their services to to their sales to the business sector will continue to increase. Of course, all of us have joined here using data services. With the 5G, you observe that when you buy a 5,000 naira data, within 2 weeks, it's finished because the speed is higher and the consumption rate is higher. So we think they will continue to propel the telco companies. Remember also that many of them have actually launched their mobile money, and that is gradually permeating the nooks and crannies of the country. So they now have multiple revenue sources. They have voice revenue, they have the data revenue, which is now becoming the big elephant. And then you also have the mobile banking revenue. The consumer goods sector, this sector recorded improvement despite the challenges of that sector. We had said during our presentation last year, during the first quarter presentation of this year, that this sector is a critical sector in the sense that when everything fails, people will have to eat, and food is the last item that people adjust their consumption away from. So we saw the likes of FTN Cocoa leading market gain. Of course, we know FTN Cocoa because there is an acquisition by OH Ecosystem Limited as a majority shareholder in FTN Cocoa. I mean, not field investment in FTN Cocoa through OH Ecosystem Limited. So that is what propelled the 696% increase in year-to-date price of FTN Cocoa. The Bua Food gained 109%. Dangote Sugar has gained 55%, and Cabre has gained 46%, while Okumo Oil has gained 42%. So we expect, I had mentioned earlier that if the government at the three levels are able to deploy the savings from subsidy removal and as well as the increase in allocation that will come from adjustment in exchange rates and invest those in infrastructure, they will employ a lot of people who will be previously unemployed, and that could lead to these people having new income. And you know that for those that are rung of the ladder, lower rung of the ladder, their priority is food, shelter, and clothing. And that means the consumer goods sector should be a beneficiary of government aggressive investment in infrastructure. And that for us is a route to begin to restructure the economy and as well as moderate the social impact of the subsidy removal. But the other things we think the government need to do, but we'll come back to that. The insurance sector has talked about this, and I expect, like I said, I expect that one of the things that the government should do is to complete the reform of the capital base of the insurance sector and allow that industry to consolidate. There's already some level of consolidation that was business-driven, acquisition was business-driven, but we think they need to go beyond, and the insurance industry should be a vibrant contributor to the financial ecosystem. Despite the challenges of capitalization in that sector, many of them are considered penny stock, and investors went aggressively bullish to acquire penny stock. International Energy Insurance recorded year-to-date of 282%, Lasaco 103%, Wapik 97%, Cornerstone 83%, and Mansa 97%. The fixed income market, we saw a moderation in yield and an increase in prices of Nigeria of most Eurobonds that we tracked, particularly Nigeria's Eurobonds. We saw an uptick in prices and a moderation in yield immediately after the announcement of the pronouncement that the president made on his inaugural speech, during his inaugural speech. This was a reversal of what we had at the end of March. Like I showed us a slide, what happened in the equities market in those 2 months or 3 months preceding the 2 months preceding the election, and the election immediately after the election also reflected in the fixed income space. But we've seen a reversal of that, and we've seen a 10.6% yield to date on Nigeria's Eurobond instruments on average. A $500 million federal government bond with maturing, Eurobond with maturing in 2023, I think the government has to make efforts to pay because it cannot roll it over. I'm not sure there's any scheme that the government has of issuing a Eurobond in this month. The fixed income space also follow the same trajectory. We've seen yield go up. We saw yield previously go up and has now moderated in that space as well. We're running out of time, so I'm trying to quickly. In Treasury bills, if you look at the average Treasury bills yield on the right slide, on the right graph, you will see moderation in terms of yield in all tenor buckets. The left side actually captured that more succinctly. You see the 365-day bill moderate to just about 8%. You've seen the 182-day bill and 91-day bill. Okay, 91-day bill had actually gone up in June, but the 182-day bill came down and they almost saw a convergence. So in effect, the Treasury bills are also mirroring what is happening in the fixed income space, because the Treasury bills are at the short end of the market, and whatever happens in the fixed income space at the longer end of the market will have direct impact on the short end, unless you have an inverted yield curve environment. Money market liquidity is going to improve further. I had mentioned that with the expected increase in FAC allocation, it will flush into the market system, and we should expect interest rates to moderate further at the deposit end of the market. The FX outlook, we think the exchange rate the way the exchange rate we said is still cannot be defined yet, because we expect to see liquidity. We've not seen liquidity. There has to be liquidity in the FX market. The floating of the exchange rate needs to be supported by liquidity. That liquidity should first go to clear the areas of unmet demand in the CBN windows, letters of credit, remittances. And once we do that, we expect the central bank to show what we call a show of power or a show of force by clearing those areas and creating an impression that it has the capacity to meet obligations. And that way we should see a much higher increase in supply. But today, because we're not seeing that increase in supply, we saw the exchange rate close at 773 naira to $1 on 30th of June in the parallel market. And that seemed to have gone slightly up as of today. I think we've done more than an hour. That basically brings us to the end of the presentation. We will expect to take questions. This is about Kali. Who are we? We are an investment banking firm incorporated in 2015. We've been in operation since 2006. We're a fund manager. We're a broker license. We're issuing house. We provide financial advice services. We also manage funds. We have 3 mutual funds, a fixed income fund, an equity fund, and as well as a mixed fund. And then we are launching a dollar fund in the next couple of weeks. So on that note, I thank you for listening. I expect to get your questions. Folake? Folake, you have the floor. Can anybody hear me?
Okay, yeah, we can hear you, sir. While we wait for Folake to...
Thank you so much, sir, for such an insightful economic analysis of the second quarter. We're so optimistic that the policies that the new government has placed will remodel the economy and bring about growth and development. Well, we might not be able to take a lot of questions because of our time. Like I said, if you have questions, please, you can forward them to our social media handles.
Okay, we can take a few questions. There's a question from Charles Achano. He said, with CBN no longer going to intervene in the foreign exchange market, which area are we expected to generate the needed foreign exchange to pay for our invisible and invisible trade obligations? The central bank will continue to intervene in the market. The central bank remains a market maker because central bank is about 90% of the foreign exchange earnings. So what will happen is that if you are paying for invisible, just go to your bank and submit your application to your bank, and your bank should be able to bid in the I&E window for you. It's just that you're not going to get at say, previously lower market rate. So the app window is still there. Central Bank will continue to sell FS in the market. And what I said earlier is that Central Bank needs to show a show of strength or a show of force, like they say in the military, where it can say, I can have the capacity to clear the arrears. So at some point in the medium term, we will begin to see multiple flow. We are going to see a strengthening in the capital flow, capital importation. We will see possibly improvement in export earnings. And that's when we are going to have central bank may now slow down on its market making role. But for now, central bank will continue to intervene in the market. Sadiq Usman, great. We can have the slide. Sure, the slide will be sent to anybody who registered to join this presentation. Okay, that's also Pius Nkemka. Can the slides move? Will the slides eventually start moving? So let me see the other questions.
Okay, so we have a question from Tolu Lokwe. How do you advise those in the education sector as prices keep increasing? How do business owners cope? Those went further and said, once you increase cost of services, you begin to lose customers. Please advise, how do we beat inflation and constant rise in the cost of living and prices in the market?
Okay, let's start from the education sector. She did to phrase that it mentioned. It's one sector that one you need to continue to increase salaries of your employees, the teachers and the non-teaching staff. But the surest way to moderate the impact of increases in prices is to improve the quality of your curriculum and teaching as to attract more students. So it's one sector you can leverage on economies of scale. The other thing you need to do is that because most of your content are local, unless if you have run a British or American curriculum where you are affiliated to a foreign educational institution. But if you are not running a foreign curriculum, most of your input costs are local. So I know that a number of schools have actually advised parents of some increase in tuition fee in the coming next academic session. So you can also explore that, but the increment should be so that it will not break the back of your parents or will not drive away students. But the most important thing is that if you maintain quality, you will continue to attract fee-paying parents. Remember that the number of parents send their children overseas to go and study, and they are still able to send that. But that's not to take away the fact that we are going to see a reduction in living standard. We're going to see a spike in cost of living, and some parents are going to struggle, or many parents are going to struggle to meet obligations like education expenditure. But to beat inflation in the country today,
Thank you.
will only mean that you have to front load your purchases. So if you can borrow from your bankers and buy things that you will need in the next 3 months and 6 months, and you have a strong cash flow that can pay back that debt, then it's the way to go. At period where the outlook on inflation is that inflation will rise is when consumers can front load their purchases so as to lock in on lower prices. There is a question on what's the outlook of the Naira performance to $1 in the rest of the year. Like this say that it's still very hazy because I'm not sure how much the central bank has to defend the local currency. Not necessarily call it defend the local currency, to support the local currency. My take is that the government or the central bank must have must have to look for a war chest to sustain some level of stability in exchange rate. If it allows the exchange rate to depreciate significantly in the next couple of weeks, then the impact could be a social issue because automatically the price of petroleum product will go up. And if you see an exchange of 1,000 naira to $1, which I don't expect to happen, then a lot of things the share impact can be very monstrous in the sense that price of fuel could get to something like 800 naira per liter, and most households can no longer afford transport cost at that level. Should we expect, Michael Ayodele, should we expect the local bourse to continue the bullish momentum till the end of the year? No. No market will continue on such steroid ride for the entire year. At some point, profit taking will take place, and then you will see a moderation. And then investors are going to also wait to see performance report of first half performance report of quoted companies and be sure that it's in tandem with the prices of those stocks. If it's not in tandem with the prices that the stock have gained, then investors will begin to adjust their portfolio.
Okay, we have another question from Joshua. Please, can you throw more light on the dollar mutual fund that Kari is embarking upon? And let me take another question. So that any stock recommendation from you?
Okay, on the Kari mutual fund, what we have done is we've gone to SEC to get approval for which we expect to come out in the next couple of days. And that approval is for us to launch a mutual fund in dollar terms. So what that means that you can invest even $10,000, $5,000, $2,000 in a dollar mutual, in a collective investment instrument, which we'll use to invest in Eurobond instruments, so that will kind of insure you against further naira depreciation. So whatever you have invested at that point will enjoy that dollar stability. And so we're creating assets that we are going to invest in from those contributions that investors are making in terms of mutual fund investment. And we hope that fund will be launched in a matter of weeks. In the next few days, we'll come back to the public, announce the launch of that mutual fund. So begin to put aside your money, dollar, and you can actually move it to us for a temporary investment purposes, and then we can now move it to the mutual fund when we launch it. What stocks can I recommend? The oil and gas sector remains strong, like I did say earlier, but we have to approach it for further details on specifics. We think because of the removal of subsidy, operators in that sector, particularly those with a large network of branches or retail outlets, will gain from this. They are no longer restricted to taking one product a month from NNP. So yeah, we're going on their capacity. We think the telecommunications sector will remain strong. The banking sector will remain strong. In terms of unique specifics, we can discuss those details of outside the presentation.
Okay, thank you so much. I think that was an interesting response to the question. I have another question here from Honor, which says, what is your perception about the push for regulated Bitcoin products by global investment firms and stable coins? Then another question from Anonymous says, last week, the NAV of SEC licensed dollar funds grew by a record 87% to 470 billion. What is responsible for this growth?
Okay, let's start from the push for regulated Bitcoin products by global investment firms. Of course, we know the central banks to this virtual money or cryptocurrency, and we had been pushing to regulate the cryptocurrency space. So what invested cryptocurrency environment products that are accepted by the regulatory authorities, the central banks? We know the US central bank has become very averse to that. We know there's even a crypto that even the promoters have disclaimed in Nigeria, and SEC has announced they will lose their money. So that's what investment firms are asking for, that let's have some level of regulation around stable coins so that we know which coins are approved by SEC, because remember, these have turned out to be investment instruments everywhere in the world. So that's what's going on. On the reason why the net asset value of SEC licensed dollar funds grew by as much as 87% to 470 billion. One of which could be, there are two factors. One is that the investment made with these funds have generated good returns. The second factor is that if you are converting the earnings and the current value of those funds at a higher exchange rate, you're going to see this kind of appreciation in the value. So two factors, investment returns and exchange rate devaluation. I was thinking I could go to that, but I just realized that.
Okay, so I believe the GMD has done justice to all the questions asked, and more importantly, has provided a prospective context to the Nigerian economy while preparing us for the coming months. At this section, I would like to invite the Senior Vice President of Cowrie Asset Management in person of Mr. Okudili Ego to give us vote of thanks.
Thank you, everyone who has participated. Thank you, our GMD, for very insightful 1 hour, 25 minutes that we've had so far. We commend and thank everyone who have created time out of their very busy schedule to listen to our quarterly webinar. This is our 7th in the series. We promise to bring another series by the first week of October. Now, in Cowrie Asset, our objective is to ensure that all stakeholders, especially the investing public, are equipped with adequate knowledge that can enable them to take good investment decisions. So our aim is to create wealth for everybody. Media handles is always active. If you visit our social media handles, we will populate and publish market trends, market developments, and insights, and we'll have dedicated staffs who can engage you on the social media and answer any of your questions or inquiries concerning the economy, finance, and investment generally. Once again, we thank you for your time, and we hope that by the next series that will come by first week of October, that you join us again. Thanks, and God bless you.
Thank you, everyone. See you next time.
God bless.